What is the formula for quick ratio? Quick asset divided by current liability. Your current asset you will find in your asset side, and current liabilities you will find under liability side. Your current asset is lesser than your current liability. It must be at least 1:1. Hello everyone, this is your Adarsh sir, lecturer in Vidhyaashram First Grade College, the Temple of Excellence. So we are in the session 5 of your topic called accounting. So your subject name we call it as accounting, but in accounting we have topic called your ratio analysis. Now ratio analysis comes under chapter number 2, like your financial management. Now, so what is the agenda for the day? The agenda for the day is very simple. We will discuss the problems on current ratio as well as quick ratio. Now, what is the formula for current ratio? In the previous session, we discussed current asset divided by current liability. We will understand what is current asset and what is current liability. Now, what is the formula for quick ratio? Quick asset divided by current liability. I will show you that. For current ratio, current asset divided by current liability. But what is the formula for quick ratio? The same formula, quick asset divided by current liability. Current asset will be replaced with quick asset. Now, so we'll understand what is current asset and what is current liability with the help of problem. Now, so these are your liability, these are your asset. Your current asset you will find in your asset side, and current liabilities you will find under liability side. Now, what are the current asset? Remember, your any short-term things like your loans, short-term loans, your provisions if it is a short-term, your creditors, bills payable, bank overdraft. These 5 we call it as current liability. Again, I'll explain. So, your short-term loans, your provisions, your creditors, your bills payable and bank overdraft. These 5 we call it as current liabilities. We will find is there any current liabilities. Now, equity, no. 5 things, remember that these are called as long-term or as non-current liabilities. So these are equity shareholders fund, debentures non-current liability, P&L shareholders fund, bank overdraft, creditors, provisions. As I told you 5 things. Which are those? Remember your provisions, creditors, bills payable, bank overdraft and short-term loans. These are called as your current liabilities. Now, so we're done with these things. Out of this, these 3 are called as current liabilities. Now, which are current asset? Now, out of this, if it is for long term, we don't consider as a current asset. Like in this, building is for long term. We will not consider it as current asset. Stock. If you sell the goods, the stock varies. If you purchase raw material, the stock increases. So every day the stock won't be actual or same as it is. It will increase or it will decrease. This is called your current asset. Similarly, debtors, it always changes. Debtors means what? How much you have to receive from your customer. If somebody comes and give you his balance, your debtors will be reduced. Today you have done some sales on credit, your debtors will be increased. These kind of changes will happen every day. That's why debtors are called as current asset. Now, cash in hand. every day. Today you have 1000 with you, tomorrow the 1000 may be 1500, or tomorrow the 1000 will become 800 also. If you spend, the cash reduces. If you earn, the cash increases. This is all about your current asset. One more thing is prepaid expenses. This also we call it as current asset. So prepaid means what? Your expenses, your electricity for next month, you have paid now only. So why you will pay now? I'll give you an example. Now, your electricity bill is 978. What is your electricity bill? 978 for the month. You go to electricity office to pay your electricity bill and you have 500 rupees to notes. Now, you paid 1000. How much you paid? 1000. The person who is sitting to collect the electricity bill as well as money, he doesn't have balance. He doesn't have change. What he will do? He will say that, sir, I don't have 22 rupees balance. Like if you are given 1000 means he is supposed to give you 22 rupees change. He doesn't have change. What he will do? He will adjust for next month. Whatever the payment receipt you will get in this 978 paid, 22 rupees advance paid. Whatever next time you get 1022 something, if you get this 22 will be reduced, only 1000 will be received, like that. So these are called as prepaid expenses. Future expenses you have paid now itself. Any doubt? No doubt. Now, so these are called as current asset. Hope you understood which are current liability. 5 items I told you, those are current liability. Assets easily you can identify. If it is other than long term, we call it as current assets. Now, so we understood these things. We'll go for your answer. How to do your current ratio as well as your quick ratio. Now, current ratio is equal to current asset divided by current liability. Now, current asset divided by, don't go for this formula. This is not required. Directly you can go for current asset divided by current liability. Under this, what is your current asset? Now, we'll check your stock you have. I'll go back. 1,26,000, 90,000, 22 as well as 7,200. 1,26,000, 90,000, 22 and 7,200. Add everything. If you add everything, you will get 2,46,000. Hope you understood. All 4 items, 1, 2, 3, 4, except your building, we have considered all the current asset items. Now, what is your current liability? Take these things. 60,000, 2,40,000 and 6. These 3 are called as current liability. Now, 60,000, 2,40,000 and 6. These 3 are called as current liabilities. Add everything, you will get 3,06,000. Hope you understood. So this is all about, we call it as your current asset and current liability. What is the formula? Current asset 2,46,000, current liability 3,06,000. Always remember your denominator, always it is 1. How come it is 1? Take your calculator. In the calculator, 2,46,000 divided by 3,06,000. Again I'll repeat, in your calculator, 2,46,000 divided by 3,06,000. You will get 0.80. This is always 1. Why it is 1 means you're taken this one as a base. On this only you're calculating. You're dividing 2,46,000 with the help of 3,06,000. That's why the 3,06,000 is always 1. So whatever answer you get, that will be first one and the second one will be 1. This is called current asset divided by current liability. Is it beneficial, good or not? It is bad. Why? Because your current asset is lesser than your current liability. It must be at least 1:1. But here, less than 1. The company is not healthy. So how to find out a company going good or bad? With the help of this, we can find out, because your loan must be equal to your assets. Similarly, your outstandings must be equal to your receivables, or it must be more or it must be equal. I'll give you example. Like, you're supposed to receive 20,000 from your friend, means the receivable part, you have given 50,000 to your friend and you're supposed to receive 50,000. Now, so how much is receivable for you? 50,000. You're happy that tomorrow, day after tomorrow, you will get that 50,000. You have to pay bank loan of 50,000. Now, still you're happy. Why? Because you have a loan of 50,000. You have receivable of 50,000. Whatever you collect from your friend, you can give it to bank. So we can match. The company is in the safer position. But your receivable from your friend is 40,000. Your payment to the bank is 50,000. 50 has to be paid, 40,000 has to be received. Still 10,000 you have to arrange. So your company is not in healthy position. Hope you understood. This is called as current ratio. We'll go for the next, quick ratio. Quick ratio will not do any changes. The same thing, but formula will be quick asset divided by current liability. Current liability, how much we had? 3,06,000. No changes. We take 3,06,000 only. But current asset, we do some changes. What are the changes? Means out of these four, like 1,26,000, 90,000, 22 and 7,200. Out of this, remember, this one and this one will not come under quick asset. Your stock and your prepaid expenses will not come under your quick asset. Remember, under quick asset, what will come? What will not come? Normal current asset minus stock minus prepaid. These two things we have to remove. Now, what is the value? 22 plus 90,000, it will come 1,12,800. See, we have considered stock, we have considered cash in hand. Now, the same thing, 1,12,000 divided by 3,06,000, you will get 0.37:1 or 0.37:1. As I told you, the denominator or base, always it must be what? 1. So as per this, it is 0.37:1. This will be your answer. Hope you understood. So before I'll go to next problem, I'll go back. Please take a screenshot. So this is your problem number 1, the solution part. And this is the second part of your solution. Now we'll go to problem number 2. Before we go to answer, we'll find out which are current asset and which are current liability. Now, stock, debtors, bills receivable comes under even advance tax, cash. Up to this, we call it as current asset. Clear? Stock, debtors, bills receivable, tax. Advance tax means what? Prepaid expenses. Cash. Up to this, we call it as current asset. Now, in this, creditors, bills payable and bank overdraft, we call it as current liability. Now, what is the total like? 25 plus 20, 45,000, plus 5, 50,000, plus 15, 65, it will be 67,000. Your current asset is 67 divided by current liability. Now, 30 plus 20, 50,000 plus 2, it will come 52,000. Any doubt out of this? No. We'll go for the answer whether it is the same or what. Like, what is the total? Your current asset divided by current liability. We call it as current ratio. Now, stock, debtors, bills receivable, advance tax, cash, all put together, you will get 67,000. Now, in this, your creditors, bills payable, bank overdraft, all put together, you will get how much? 52,000. See, 67,000 as per our calculation and 52,000 as per our calculation. Now, 67 divided by 52, your answer 1.29 is to 1. The denominator or base always 1. See, whether the company healthy or what? Yes, healthy. Why? Because your payable is 1, but receivable is more than 1. Like 70,000 you have to receive from your friend, only 50,000 you have to pay to the bank. Still 20,000 is with you only. So this is called the healthy one, healthy ratio. Clear? This is called your liquidity ratio. Now we'll go for quick ratio. Quick asset divided by current liability. Remember, the current liability 52 will not change. Now this will be 52,000 only. We will not consider your advance tax of 2,000. We will not consider the stock of 25. For what reason? It is a quick asset. In the quick asset, anything advance or prepaid, we will remove. Anything related to stock, we will remove. Now, out of 67, remove this 27. How much it will be? 40,000. Now, 67,000 minus 25 minus 2, it will come around 40,000. Now, the answer is very simple. 40,000 minus 52,000. Your answer is 0.77 divided by 1. Now, as per this, as I told you, 1 will be your base and 0.77 is your answer. Company is healthy or not? Not. Why? Because lesser than 1. Now, this is all about your liquidity ratio. I'll go back. You can take a screenshot. This is your problem number 2. The solution part of problem 2. The second part of your solution. So this is all about your today's session. Hope you got idea about ratio. Easy or very easy? Very easy. Now, these kind of ratios will be there. So in further, we'll go for other kind of ratios also. So please update and please write down all the notes whatever given in the class. Thank you.